crypto really is not that complicated. All that matters is what is noise versus what is signal. We have to figure out what kind of news can we completely ignore and what kind of data does actually matter. Now in this video, we're trying to look at the data that actually makes the ups and downs in the market to figure out where we currently are in the overall cycle. Now here is what a lot of people talk about: the Bitcoin ETF. As in, how much money is flowing from traditional Wall Street to crypto and from crypto to Wall Street. And in general, it's a good thing that the Bitcoin ETF exists, at least for the price. Because since the launch in January of 2024, we have seen how the holdings of the Bitcoin ETF tended to trend upwards. We're very close to the all-time high. And that all happened while Grayscale tended to sell. Because before the Bitcoin ETF, there was the Grayscale Bitcoin Trust. And we couldn't directly convert from the trust to Bitcoin. So there was a mismatch between the underlying assets and in the end the price of the different shares. But then with the approval of the ETF, there was a conversion. And with that conversion from the trust to the ETF, a lot of Grayscale Bitcoin Trust holders tended to sell. But that selling was not strong enough to offset the growth in all of those other new instruments. Here are the ETF flows over time, again with the different instruments. But that then poses the question, is this signal or is this noise? Now for the very long term, as in over the next 10 years, this is signal, as in this is a supporting force for crypto prices. But for the short term, I dare to argue that it might be noise. Now we can smoothen this out a little bit. Then we get this chart. So this is the ETF supply chain, excluding the Grayscale Bitcoin Trust. And interestingly enough, it seems like the ETF holders tend to not time the market that well. They bought a lot at the top when Bitcoin was at 70K. They didn't buy for the lower prices of 54K. And then they bought in again at around 100K. And then they sold when the price went down to 80K. So one might argue that this could be a counter indicator, as in Jim Cramer making a recommendation for a stock. This could be also an indication to do the exact opposite. But I think there's actually a better indicator, and that's this one over here. It's the long-term holder supply chain. Now, first of all, we notice how most of the time the long-term holders do the opposite of what the ETF holders are doing. In other words, they sell when the Bitcoin price is high, they buy when the Bitcoin price is low. Again, here they sold when the Bitcoin price is high. But what we also notice is that the magnitude of those movements is much larger than what's happening with the ETF flows. So while it's nice to have an ever-increasing balance in the Bitcoin ETFs, it's better not to take those flows as an indication for the short-term price action. It's probably better to look at the long-term holders. Let's take away the ETF data. Let's just look at the long-term holders. What is different in the recent past here? We see a lot of purchases by the long-term holders. They are accumulating, but this time they are not accumulating when prices are low. They are suddenly buying when prices are appreciating. Now, why are they buying? Your guess is as good as mine, but historically they have been pretty good at timing the market. So maybe the long-term holders expect the price to continue to rise from here, even though we are already relatively high in the Bitcoin price. Now, interestingly enough, I'm doing very similar things to what the long-term holders did. I sold over here, I bought over here, I sold over here, and I also recently bought back in again. Now, why did I buy back in again? It was because of this indicator mainly. It's the 120-day simple moving average. I talked about this several times on this channel. So the idea is relatively straightforward. We try to follow the trend. When the price is above the moving average, we want to buy. When the price is below the moving average, we want to sell or even short the market. And historically, this was a very, very good strategy. We avoided crashes like this, and we bought in when Bitcoin was still below $20,000. And yes, there are our failed signals every now and then, but in the grand scheme of things, even if we lose 2 or 3% with those bad signals, if that means we can take advantage of 50% rallies, while we can avoid crashes of 65%, those kind of small failed signals are worth it. Now, why 120 day? It's because historically it worked the best. I ran several back tests on this, and it's always the 120 day SMA that works the best. Now, I'm not going to repeat that data again on this channel. Feel free to check out older videos. I might explain this in more detail, maybe again in 1 or 2 weeks. So feel free to subscribe not to miss that video in case you're not yet aware of that data. Now here's another potential explanation. Maybe the long-term holders now see how there's still money flowing into the system, as in the stablecoin market cap is going up. There are transfers from the fiat system into the crypto system. And that's happening since October of 2023. So the market is clearly expanding, but at the same time, we also see how there's still some dry powder on the side. Now this here is the stablecoin dominance. It's not the stablecoin market cap, but the stablecoin dominance. And it shows what fraction of all of crypto is currently in stables. So at the top here, that's 9%. At the bottom here, that's 5%. And we had been in this trading range for the last 1.5 years. So maybe the long-term holders are just seeing this as well, and they're working with the obvious that the stable coins might get deployed and that the stablecoin dominance goes down. Thus, crypto prices could go up. If something like November of last year repeats, then we would see Bitcoin reach $130,000 to $140,000. So that's the kind of percent increase we saw during that stablecoin deployment phase. If we see again the stablecoins getting deployed, that's the potential ceiling. In the end though, I try not to work too much with price targets, with US dollar targets. I think it's much more important to see what are people doing in particular points in time, because there can always be surprises. I try not to reinvent the wheel. I just try to figure out what are the smart people doing. For example, the whales in Bitcoin, the people that have so many Bitcoin and that have held it for a long time, that tend to be the diamond hands of the space. When they suddenly start moving their Bitcoin, when the Bitcoin price went up, maybe it makes sense to also consider selling. Because that's the beauty of the blockchain. We can actually see all of that data. We don't see this for any other market, but for crypto we can see it. And so what we've got over here is the value days destroyed multiple, or VDD. Now what does value days destroyed mean? It means we're looking at the Bitcoin that haven't moved for a while, especially the large wallets. And when they ever move, then this indicator goes up. So let's say there are 100 Bitcoin and they haven't moved for 10 days. And then after 10 days they move, then we're destroying 1000 value days. Now, if you've got Bitcoin that haven't moved for 10 years, and it's 100 Bitcoin, then we are destroying 1000 value years. So then this goes up, of course, much more. So the longer the Bitcoin has been dormant for, and the more Bitcoin there are that suddenly get reactivated, the higher the spikes. And the indicator does not necessarily always show the perfect top. So for example, it peaked when Bitcoin was at 40K, and then it still continued to go up to 60K. For example, over here, it peaked at 72K and still we went up above 100K. But it tends to be a pretty good indicator to at least take some chips off the table. It's a first profit-taking opportunity. And when you're buying below 20K, then you're making a 3.5x just on Bitcoin. Then it might make sense to actually take some chips off the table, right? It might make sense to rebalance the portfolio and buy something else potentially. I think it always makes sense to follow approaches that worked in the past. So that's better than just gut feeling, right? When we've got an approach that at least had some validity in the past, it probably makes sense to at least use this to a certain extent in the future. And so this here is the realized HODL ratio. So how much speculation is there currently among the short-term holders versus transfers among the long-term holders? When there are a lot of short-term holders transferring, that means the market is very heated. It means a lot of tourists enter the space. It means we should potentially sell. When there's not that much short-term activity, it's only the long-term holders that dollar cost average in the market. That's when we want to buy. And currently we are not yet at the ultra heated levels, right? We have been much higher when Bitcoin just moved to the 100K. Currently the market is less dangerous. Now there's an interesting combined metric, and that's the CBBI. Feel free to search this in Google. The realized HODL ratio is one of the metrics that's used in this chart. And when we look at the combination of all of those indicators, we've got a very nice oscillator between 100% and 0%. And so the idea behind something like the CBBI is that no model is perfect, but some are useful. And if we combine them all together, we might get a more refined look. And so how can we use something like this? When this is high, of course, we want to rather take profit. When this is low, we want to rather buy. But nobody knows if this indicator will be perfect at indicating the tops and bottom. For example, we were at a value of 2 in January of 2005, but we only reached 5 in December of 2018. Or here with the tops, we were at 100 in December of 2017, but we only reached 97 in February of 2021. And what about those medium-term runs? Because over here, Bitcoin still moved from 13K all the way to 5K. So this was also a 66% drop. Do we never want to sell over here and buy over here? This, by the way, was the COVID crash. Here's a potential way to use an indicator like this. I believe it's a strategy that works. We could use this indicator as a measure of how much we want to be in cash. So let's say we have a certain allocation for that strategy, right? We've got a diversified portfolio with all kinds of things, with stocks and property and precious metals. But let's say we've got also one allocation for crypto, risk on and risk off. For that allocation, what we could do is we could just have the Bitcoin allocation based on this CBBI. And we could rebalance periodically, let's say once a month. What that means is we are 99% in Bitcoin when the CBBI is at 1 and we only have 1% cash. And then as we are going up, we are selling that Bitcoin. So at the point over here, we are 50% in Bitcoin, 50% in cash. We continue to sell, and then at the top, we have sold it all. Then we wait for Bitcoin to crash by 80%, right? That's what happened over here. Bitcoin went from 20K to 3.5K. And during that crash, we buy more and more and more until we've got a 100% allocation almost, or a 95% allocation once we are at this bottom. Then we are selling again as we're going up, we are buying again as we're going down, etc. So you can have a dynamic approach to this. We are not trying to figure out where the exact perfect bottom is. We're not trying to figure out where the exact perfect top is. We are simply just allocating based on where we see currently how heated the market is. Now this would tell us that we should be mainly in cash right now. I'm currently, as said, very much risk on. I'm following what the long-term holders are doing, but I can afford that risk because I'm going to limit my exposure significantly once we go below the 120-day SMA again. So I am not speculating with my entire portfolio and then ride the wave down. If Bitcoin suddenly crashes to 90, 80, 70K, I'm going to cut my losses very, very soon. And that's why I'm okay to be quite highly exposed right now and to bet on the CBBI to potentially go higher. Then of course, once we are close to the 95 levels, it might make sense to sell, even though we are still above the 120-day SMA. But at that point, we're probably going to see how the value days destroyed metric spikes again, how the smart money goes out of the market, and how then everybody, all the tourists, are back in again. And so the cycle just always repeats, right? Crypto is a mechanism to transfer money from the not so skilled and from the very impatient people to the people that have a bit more patience, that can afford to hold longer. The long-term holders tended to do the right thing. And I believe they will continue to do the right thing. They are now heavily invested, so am I. And 130 to 140K in Bitcoin, I believe, is very much possible. All that needs to happen is that the current stable coins get deployed. The money that's currently on the sidelines just has to get into the market, as it happened in February of last year or in November of last year. Now, after so many years in crypto, I think there's only two strategies to make money in this market. It's either trying to find altcoins very early, potentially using wallet tracking, buying things before the masses do. And while this is a strategy that can work, it's also comparatively risky. Things like Virtual Protocol or SPX 6900 went up massively this year. But if instead you bought Optimism or IMX or Polygon, you wouldn't have had such a nice time. Now with small bets, a few $100s here and there, the strategy does make sense. But for the vast majority of the portfolio, we have to take less risk. Now, the common narrative is that this less risky bet is simply Bitcoin. And while it's true that there's less risk in Bitcoin than in many altcoins, the price can still go down by 77%. So what can we do? I think the answer lies in taking advantage of crypto's market structure. most altcoins underperform Bitcoin most of the time. So for example, have a look at this again, right? This is the performance of the top 100 cryptocurrencies in the last year. Again, SPX 6900 outperformed everything else. And here at the bottom, we see Bitcoin. So in the last year, Bitcoin appreciated by almost 72%. Now, how many altcoins outperformed Bitcoin? It's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. Out of 100 altcoins, 17 outperformed Bitcoin and all of the others underperformed. And so with a larger part of the portfolio, we can take advantage of this market structure. So instead of buying Bitcoin, we can buy this here. Now, this is the exact same time frame that we see in those charts. And what we see here is again a Bitcoin chart, but it's slightly different. It's not Bitcoin relative to the US dollar, it's Bitcoin relative to Balancer. So what we are seeing here is Bitcoin's relative performance to one of the altcoins, an altcoin that tended to underperform over the long term. Now, why do we see that constant outperformance of Bitcoin over the alts? So it's not just that most altcoins underperform, it's also that the underperformance tends to be rather constant. The reason for this is tokenomics. It's an expanding token supply. Because that's how the venture capitalists and the members of the teams of all those projects make their money. They've got a vesting schedule. They get a token allocation, but they can't sell directly. They have to sell over time, and that depresses the price relative to Bitcoin. Yes, on bullish days, everything is going up. But when we zoom out a little bit, most altcoins are not doing as well as Bitcoin. Now, this is not common knowledge, but we can actually set up a position in a portfolio in a way that we make money when the relative performance of an asset versus another one is going up. So we don't have to bet on the crypto macro. We don't have to bet on Bitcoin going up or down. We can just make money when something outperforms or underperforms. Now, I've made several tutorials on that topic, how to profit from falling prices or gaining from relative valuations, or over here, how to win in bear markets by shorting altcoins. Now, it's not important what the macro is doing if we focus on the relative valuation. Again, the nice thing about the strategy is that it works in any market condition. At the bottom is again Bitcoin. Bitcoin has its massive crashes, and the largest retracement that we saw in this chart was maybe 50%, while the gain was much, much larger. So this is an 8,000% gain in relative valuation, while Bitcoin itself only made 100%. And so I'm of course sharing my own trades as well. Check this out. This is where I opened a short position, a relative short position on the Trump token. That was on April 30th. What we see here is Trump relative to Solana. Some community members entered the short as well. And then I closed the position a few days later for a gain of 142%. Now, I actually shorted Trump twice, so this was an earlier trade. And again, here are a few other trades that our community members are making. So if we set this up right, if we've got risk management and hedging properly in place, there is real risk-adjusted alpha in positions like this. And so of course I shorted the Trump token again because of the tokenomics. Over time, the Trump supply increases. And it's really important to understand this concept. I believe that risk adjusted, if you want to make large bets, not just a small bet on the altcoins that might do 100x, if you want to bet a lot of money of our portfolio, then we have to bet on something that risk adjusted performs relatively consistently. So this is Trump in US dollars. And if you just bet on Trump going down, then when the market itself is appreciating, you've got a problem, right? Over this time frame, Trump did not go down. However, Solana relative to Trump went up. So that's the exact same time frame. That's a gain of 35%. So it's all about looking at what tends to do worse relative to something else over time. And how to set up those positions is explained in the videos over here. And so feel free to check it out. It's currently $125 per month. It used to be 165 at the peak of the bull run. Now attention is still relatively low, and so you can lock in the lower rate. I will not increase the rate for anybody that's already subscribed. Only the people that sign up when everything is hyped, they will get the higher price. But if you sign up now, you lock in that price. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated. appreciate as well. It helps the channel grow. Feel free to also check out Premium. Again, the link should be somewhere over here. You can just click on the link here. It should bring you to the website. And so yeah, see you next time on YouTube or see you in Premium. Cheers.